Welcome to Willow Oak Asset Management's Value Hour. This is the first in a series of presentations showcasing our affiliates and partners. My name is Stephen Keel. I'm the portfolio manager for Arquitos Capital and also the chairman of Willow Oak Asset Management's parent company. Willow Oak hosts several in-person events each year. In light of the current circumstances, we are offering this virtual event to discuss challenges and opportunities in the current investing environment. Willow Oak partners with alternative asset managers. We are building a network of opportunities and resources for private funds and investors who appreciate and understand the principles that guide value investing today. Our participants are David Waters from Alluvial Capital. Alluvial has managed accounts as well as a fund that is affiliated with Willow Oak. It focuses on value opportunities in small companies and thinly traded issues, both domestically and internationally. Alluvial was launched in 2014, and the fund began trading on January 1st, 2017. Dave is the author of OTC Adventures and is based in Pittsburgh. Keith Smith is with Bonhoeffer Fund. Bonhoeffer was launched in 2017 and is affiliated with Willow Oak Asset Management. The fund was inspired by the courage and independent thinking of World War II hero and martyr Dietrich Bonhoeffer. Keith is based in Rochester, New York. Thomas Brazil of 507 Capital. 507 is a firm focused on distressed debt that provides capital in insolvencies and bankruptcies globally. He's also the co-CEO of Winland Holdings. Thomas is based in London. And finally, Jeremy Debo with JDP Capital. JDP invests in extraordinary businesses with the financial and cultural profile to become long-term compounders. JDP was launched in 2011, and Jeremy is based in Amsterdam. First question for you, Dave. Obviously, we experienced a sharp drop in the overall markets over the last few months. This was then followed by a big reversal in gain over a short time period. You have a unique portfolio. I'd love to hear how this dramatic volatility has affected you recently.
Was there volatility? I didn't notice. No, I'm totally kidding. It's interesting. The stuff I invest in tends to be well off the run, not held in ETFs, mutual funds, even most hedge funds or other vehicles. And so at first, we didn't really notice that the market had gotten nervous and was beginning its decline because nobody cares about most of the stuff we hold. That held for a while, but you do notice when the real panic starts to set in, which I think we saw in later March, you start getting a few panic sellers who just say, all right, doesn't matter what I'm going to get for these shares I'm selling, I'll take whatever bid there is. And we saw some rather sharp and swift drops in a few of our names. We were sitting there on that bid and picking up a few of those bargains, and I hope to do it again if things get ugly again. But that's the name of the game. You have to be ready to swoop in and grab those bargains when they're available, and be patient and set your bids at a price you think is extraordinary, whether you get the shares or not. But we've seen a rebound, but not a huge one. But overall, it's been fairly smooth sailing. It's of course it's hard to sit there and see names and companies you think are great just go down and down for no fundamental reason sometimes. A lot of the things we own are not terribly affected by the virus or by any economic contraction that results, but nonetheless, because they're a stock and because they trade, they get hit by nervous sellers. But it's about the long-term approach.
Sure. So there's some baby in the bathwater type situations. It sounds like there when you have this type of forced selling, and I'm sure that's happened throughout the world. Moving over to Keith for the perspective from Asia. Keith is heavily invested in Korea and the Philippines and looks at quite a few companies in that region. Looking at the economic shutdowns and how the virus has affected that particular region, what's your view? How are things looking from your investing universe, Keith?
Well, what's interesting about Asia is both Korea and Hong Kong have done a really good job of arresting this virus. And I think part of that was from their historical experience dealing with SARS and MERS. So they've actually had a pretty effective program of testing people. As soon as they find a group of people, they'll basically get them all in quarantine and isolate the people. So I think both countries, given the historical the historical experience with viruses in Asia, have been probably more well prepared for this than a lot of Western countries that haven't had to deal with a pandemic in probably over 100 years. And so one thing we take a look at, let's take a look at the two countries specifically that that have done very well, both Korea and Hong Kong. Hong Kong's, if you take a look at it, their relative performance is actually up versus the S&P 500 since the beginning of the year. Both of our holdings are doing relatively well there. And then in Korea, we're down roughly 4% year to date in US dollar basis, but the currency has declined by 6%. So in essence, on a relative basis, the Korean market's actually up. I mean, our holdings have experienced some downward pressure, but a lot of them they're good fundamental businesses. A lot of them are in more consumer staples types of businesses. We own the Coca-Cola bottle or the Pepsi bottler over there, the largest bottler in Korea. And so we've got a lot of names in Korea, food companies such that at this point, as a result of this, haven't been infected as much. And the general shutdown we haven't gone into a general shutdown in places like Korea and Hong Kong. There's been sort of periodic shutdowns, but it hasn't been anywhere near as much as disruptive as it's been for the US market. The other interesting thing is in all three of those countries, their currency has been flat. One of the things that we've noticed in a lot of emerging market countries is that the strong dollar has basically outperformed a number of other emerging market countries. So for example, if we look at like South Africa, Brazil, or Mexico, their currencies are down by over 25% versus the US dollar since the beginning of the year. And in some cases, that has actually caused the stock markets to be down by that or more. So in essence, a lot of the emerging markets movement in a US dollar basis has been the result of basically currency declines in the emerging markets. And I mean, in terms of our portfolio, we do have some exposure to the Philippines. One of our specific companies was in the middle of a tender offer. The tender offer was withdrawn from competitive purposes, and that was brought back in recently. So that one's been pretty flat and been pretty consistent. The other one was a TV business, which has done relatively well too. The market down there is down a good amount. It's probably down overall, probably 35% year to date. Our holdings probably down 8% because it's a much more defensive type of a name. So I think in the emerging markets, most of the exposure we have in are more, either processing type names or more defensive names that should do well in this kind of a situation. However, again, it's going to be very on a country by country basis, but both Hong Kong and Korea have done a really good job in terms of containing the virus and the potential impact. The one downside of the overall of the thing, however, is that these countries are dependent upon demands in other parts of the world, and there's not much you really can do about that. And as far as I see it, hopefully it's going to be a short demand drop for the kind of types of products and services that countries are providing to the rest of the world. So it's more of a short-term versus a long-term thing.
Interesting. Thank you, Keith. And over on the distressed debt side, Thomas, you have a unique perspective, especially amongst, I think, probably some of our followers who are more focused on equities. Looking at it from the distressed debt side, what have you been looking at? What's your view?
Most of the stuff we do, just to be clear, is in like the SME space. So it's like small and medium-sized businesses that normally have banking relationships but aren't tapping public debt markets. I would say right now you sort of have and have not. So even though there's no revenue coming into some companies, probably the most defensive place to be, just from a credit perspective, thinking about equity value, is guys that can stay in. If you can raise a few $1 billion of bonds, like that's going to be helpful to getting through this. If you're smaller on the SME side, if you start getting really small, then you get the government sort of SME program, the PPP and stuff like that. But even that is slow and maybe not going to pull you all the way through zero revenue a few months. So, and for us, we're seeing, frankly, a lot to do on the distressed credit side, whether it's like direct origination or stuff like that. Yeah, we're seeing sort of, again, I hate to use the word bifurcation, but a little bit of a bifurcation in have and have nots in the credit. But right now, there's like a lot of people sitting still. So assets that were distressed pre-crisis really should be trading, and yet people are just sort of like, I think the analogy I used the other day with someone and they liked it was everyone's just sort of holding their breath, and eventually a lot of companies are going to have to come up for air at the same time, because if this goes longer than they expect, then even a month or two and you're back at something like 50% of revenue, that could be a real issue. So we're seeing a lot of people holding their breath. Yeah.
No, I think that's a really good observation, Tom, because I think we see this overall in the markets too, because I think the companies that have bounced back have been the ones that are resilient, and the ones that are going to have issues are the ones that have gone down. So in the emerging markets, we see the same thing. We see bifurcation between the companies whose currencies are flat versus the ones that are collapsing. We see, so I think we're seeing across all markets. So that's a really good observation.
Yeah, universally, I mean, throughout the world, which is interesting, both on the equity and debt side. I'd like to move over to Jeremy with the idea of more for the allocators and investors. We've heard about kind of the investing perspective from different parts of the world and different, and with some smaller companies as well. But Jeremy, you're based in Amsterdam. You have a lot of contact with kind of European investors and allocators out there. And Europe, in certain areas, of course, has been particularly hard hit. I know you have a place that you vacation in Spain, for example, you haven't been to in quite some time. I mean, how does that work? How does the day-to-day life and how do some of the investors there view this?
Yeah, so the first observation is, so we mostly just invest in the U.S., but have some investors in Europe. And the first thing that I've seen is how different how different the virus has affected each country, and how each country is responding based on their own culture and kind of what's going on, in their own economy and circumstances that are very unique to them. In Holland, the response and the crisis has been very different, for example, from from France or Spain or Italy. Holland has not had to go on full lockdown, but obviously there's a heightened sense of awareness and 1.5 meters of separation, but people can still move around, they can go to work, they can exercise. And I think it seems to be under control a little. It's becoming more under control than our neighbors. So from an investor perspective, I think that initially the people's interpretation of the market was based on what was happening kind of within their own country. So maybe people in Holland, where they didn't feel the pain as much as maybe in Italy, for example, maybe they didn't think it was going to be that bad. But then people in Italy had the lens of, wow, this is kind of going to be the end of the world. And now that we've all had time to understand how it's starting to play out, the opinions it's kind of people are trying to think about how this is going to affect companies that they own long term. And so the types of companies that I tend to own or like are companies that are growing and that will continue to grow at the expense of lower quality competitors, or based on a trend that will be sped up dramatically as a result of a recession. And so getting that message out and communicating that to our investors has been important. But as far as individual views, I mean, everybody's investors, like I said, are kind of all in different situations, depending on where they're from. Some are better off than others, but yeah, it's still early days.
Well, it's interesting. You and I talked offline about some day-to-day ramifications in Europe there, how the internet is so overloaded, and Netflix has been kind of limiting the bandwidth here. And here in this situation, this is the reason why Jeremy is a little bit not as clear here on this call, because based in Amsterdam, they are limiting some of the video calls and things like that. The bandwidth is just not as strong. So a little bit different than here in the U.S., where I'm sure everybody is watching Netflix and Prime and Hulu and HBO Now and everything for the last month or so. And that diversity in terms of geography, kick it over to Dave for a moment. It is valuable to get this perspective amongst our affiliates and groups here. We are all based in different areas. I've been kind of self-isolating here in New York for the last few months, and we have people from kind of throughout, obviously throughout the world here as well, and other friends of the company. Dave's based in Pittsburgh. You have a young family. You have a colleague and analyst, Tom Tapfer, who also has a young family. I think it'd be interesting to hear what day-to-day life is like in your part of the world, and any thoughts you might have on when kind of more normalized economic activity might return.
Sure. I mean, it's a challenge. We're maintaining. We're doing fine. Thankfully, my family is healthy, and we're all getting along well, cooped up in our house, nearly 24/7. Yeah, my wife as an attorney, she works. Obviously, I work, and so it's difficult having a almost 4-year-old and a 1.5-year-old who just want to play and can't understand why mommy and daddy have to go up to their offices and do things. And that's tough. And I know there are so many other families in the same boat. And it's just such a disruption to our lives. It is sort of unprecedented. I mean, we all remember how things felt during the financial crisis a little over a decade ago, and it felt terrible. But at least you could take a walk outside and not worry about passing someone on the sidewalk, or you could pick up a cheap takeout somewhere and enjoy that and feel good and not worry. And honestly, this probably takes as much of a psychological toll as it does an economic toll. And I guess I do wonder about the psychology of the consumer and the psychology of businesses looking at making their investment decisions. And I guess I worry that this will have sort of an overhang and a lingering effect on people's willingness to resume normal life, with the fear that this could come back, or something similar could always happen. Because for most of us, this is the first, aside from in people and investors in certain Asian countries, this is the first time we really remember having health related restrictions on our lifestyle. And so it's a real thing. I think it's a generational touch point too. I sometimes I wonder if my young son will remember this as, oh, this was the time we all had to stay inside, even though the weather was nice, and I didn't get it at the time. But I think people, I feel especially for students who had their academic year cut short, and it's can you imagine graduating into this as a college senior or something, and then trying to find a job right now? I feel
Yeah.
for those people. And so I guess I'm a little skeptical of the view that, oh, once we figure out a treatment, or once herd immunity rises, or once the peak is over, we'll all get back to regular life in the short term. I think we will get back to a lot of our lives over the next few months, but I think there will be some real changes and lingering effects that kind of sort of cast a pall over society for potentially years. And so I think, I guess I'm skeptical of anyone who has too strong a view either way, whether, oh, this is a disaster, it'll take years to get back to normal life, or everything's fine, we'll be back to full functioning in a month. I think the truth is in the middle, and it's important to seek out a variety of viewpoints on that.
And I think if you look, I mean, one thing I'm looking at is throughout the world, as these different kind of isolation types of things are opening up in different countries, to see what's the first type of economic activity that comes back. You know, where is the pent up demand? You know, are people buying autos? Are people buying luxury items? Are people going out to try to get entertainment? Are they traveling? Uh, and that's kind of what I'm looking over the next few months here, because potentially it could be provide a little bit of guidance here to the U.S. You know, I mean, I do go for a walk usually every day or two here around New York, and there's a few people out. Of course, wearing masks and everything, but there's a lot of window shopping. You know, walking down Fifth Avenue, Madison Avenue. Uh, Not everything is being kind of delivered online if they're not essential items here. So, you know, some luxury kind of high-end restaurants are just closed, hotels are closed, things of that nature. And it'll be interesting to see what returns first. And returns, not just returns, but also is kind of enhanced, you know, where you might get significantly more revenue than otherwise might exist over kind of a time period. I just read something earlier today about there's still cruise ships. The 2021 is fairly booked. How many of those are being canceled? What's going to be the effect? But I can see people who have been kind of locked up here, especially as we come into summer. What do you want to do? In terms of vacations, you might not travel internationally as much, but possibly you go to parks or things like that throughout the U.S. and take those types of trips. So we'll see, and it'll be interesting. And then the second effect there, or another effect is now we set certain precedents with the Fed. We did this in '08, and they were able to act a little bit more swiftly, I'd say, this time around because of some precedents that were set in '08. And I want to kick this question over to Keith because those things, these types of consequences, then next time around, even if there's not a crisis as deep or as important as something like this, once the slippery slope starts, it's difficult to stop. So obviously we had interest rates, cutting that way. I mean, the Fed is buying bonds now through ETFs and things like that. Keith, it would be interesting to hear what your view is on the short-term and long-term ramifications of this, kind of unprecedented Fed action.
Well, yeah, I mean, I think this thing is clearly different than, let's say, 2008, 2009, from the perspective of, in 2008, 2009, a lot of the issue was banks and other financial companies just taking on too much leverage, hitting a bump in the road, and eventually the whole thing down. So to a certain extent, it was self-inflicted by the banks and other institutions that actually decided to take on more leverage. This case is a little bit different in the fact that you're dealing with a pandemic where the government is forcing businesses to shut down because of it. Not that that's a bad decision, but that's the result. And that's why I think you're seeing much quicker bipartisan action than you have in the past. And there's very little discussion I've seen out there now. There may eventually be in terms of the whole moral hazard issue, because what you're really, the affected people here are a lot different too. The people that are affected here are the service workers, the service businesses. Those are the businesses that are mainly affected here. And these people, for the most part, are innocent actors in sort of what's happening here. And therefore, I think there's a much more lenient approach. Now, in terms of the Fed, I think they did the right thing. I mean, the issue was what was happening. I mean, I noticed this early on, probably in early March, some of the mortgage markets started to lock up, and you had margin calls being made, and people were forced selling. And what the Fed basically said is, okay, we're going to back the thing. We're going to back up everybody that's at least investment grade. And this was something that was made last week, which is a really big help. So basically, those people are not going to get hurt. So as Tom has mentioned, and other people have mentioned, there's a number of different programs. You've got the programs for the small business, which is the direct, the PPPs, et cetera. And then you also have the backup of the credit markets, where the Fed has said they'll basically take anything that was previously investment grade as sort of collateral. So that's providing more liquidity in that market, and it settled it down a little bit. I'm sure there's still going to be some damage that's going to flow through the system. But in my mind, I think it is a correct action to take. Now, whether this will be done in the future, I mean, I would doubt it, because I think part of the issue here is that we weren't prepared for this. I think in the future, we're going to be a lot more prepared and learn how to sort of deal with these types of things. I think there's going to be, mobile hospitals around. There's going to be things and vaccines, and this is going to become a really big area of money. People are going to spend a lot of money to make sure this thing doesn't happen again, because the economic damage, I mean, we're seeing it right now. The economic damage of basically not being prepared and not having stuff up and ready to go is just tremendous, a lot more than the cost of spending a little bit of money on coming up with vaccines and these other sorts of things. So I think that the Fed has done was needed. The question now is what's it gonna have going forward? I think that once this thing gets steady, it's probably not going to be needed going forward, and the Fed can probably take more of its traditional role of, not having to be concerned about sort of the moral hazard and those companies that do over leverage, just to let them go bankrupt. But I think this is clearly, in my mind, an exception to the rule. And going forward, I think that, we'll set up something so it's not quite as bad. But I think the biggest difference between here and the 2008, 2009 is you've got a bunch of innocent people that had nothing to do with levering up. And this has nothing to do with the levered guys. Levered guys were getting hurt, but what this really has to do is even the unlevered guys, unlevered restaurants, unlevered hotels,
Sure.
Types of businesses are getting hurt too. So it had very little to do with the financing decisions those companies made. They just happened to be in the wrong business at the wrong time. And so I think the Fed's trying to come up with ways to try and deal with it. It'll be interesting to see what the outcome of this is on the other side in terms of the structures. The one thing I think we're seeing now is we're seeing a lot of stress in the system, because the financing system is not built for stuff like this. I mean, it's not built for forbearance and these types of things. And I think it'll be interesting to see the structures coming out of this, if there is some type of a buffer or forbearance for these types of situations for companies, because it's very disruptive. Where when you look at it in the big picture, if a company misses debts, or basically the debts are basically repaid at some point in the future, the effect on the DCF, on overall DCF of the bonds and these other securities is very low. But what happens is right now the system's set up, usually these types of things happen when a company's in distress and taking on too much debt. Well, that's not the case in a number of cases here. So how do you sort of deal with that sort of exceptional sort of circumstance that's causing the ripple through the system that, okay, our system set up is that these companies can't pay. It's usually because they over levered. But part of the reason now a lot of these companies can't pay is because their businesses stop because the government and everyone agrees their business should stop. And how do you deal with that?
Yeah, absolutely. Yeah, it'll be interesting to see, how the Fed, after the 08, 09 time period too, and how the decisions they made to attempt to go back to normal, which never fully occurred. And it'll be interesting to see how this happens. What is normal anymore? What new term? Maybe the new normal term coined and back in the day, that time period. What new term are we going to have? And then, what effect is it going to have on inflation? Because when you look at the long-term prospects of other companies that we invest in, inflation is, which has been non-existent for so long, will really have a dramatic effect on decision making and investment decision making there, and obviously eventually the effect on the interest rates and risk-free rate. Over to Thomas, you and your partner Brian Stout. I know you've been busy looking at a lot of deals. There's been the illiquidity in certain areas of the market, as you've already discussed. It'd be interesting to hear kind of different examples of some deals that you might have been looking at or that you're coming across right now.
Yeah, sure. So, we can go across the different deals. So on the bigger bankruptcies, guys that are filing, and if you really want to hear this about the deal flow we're seeing, we have a lot of debtor in possession loans and stuff like that are coming up. We have guys with assets but no access to the banks, just can't lend to them right now. And or maybe they don't even have any debt, so they don't even have a banking relationship. So if you don't have a banking relationship, you can't start one now. It's a little late. And so sometimes they'll have unencumbered collateral, so that could be hard assets like real estate, AR, some specialized collateral. But again, it's normally like very asset-backed lending type stuff. And it's pretty high touch, so it's not the risk that hurts you. It's you have to make it scalable, and you have to find things that work so that you don't everything in your portfolio, even though you might have collateral on it and you'll be okay on a recovery basis, you can't have everything go sideways because you'll just have all these loans to work on and you won't have the bandwidth. So you have to watch it from that standpoint. I would say that again, in the SME market where you have bigger companies filing that are over levered, or I should say they were threading the needle, because there's sort of PE-backed firms and things like that where they don't have a missed quarter in their balance sheet. They were sort of, and I would not take umbrage, but I would a little bit. There's been a lot of leverage build up in the system. I mean, Corona is just the sort of the straw that broke the camel's back. But I mean, we've been building up the leverage in the system for a while, and I think one of the things to take away from Corona is probably the fact that sometimes you have to go for robustness in your model, not just
Ability, right?
efficiency, right? You can't over optimize, right? So you over optimize your supply chain. You do just in time where your balance sheet is so optimized, you have no excess capital on it. It's like, okay, that sounds great, but that's not life.
In a perfect world. I mean, you saw that, like Boeing, for example, outsourcing, the entire supply chain and what ramifications that had. And then on the other side, like I said, on the financial side, I mean, when you're forced to roll some sort of debt over a particular time period when the market sees up, it's obviously most of the time it's not a perfect world.
I mean, even company like Disney. Yeah. I mean, even these guys that use the commercial paper market, like it's always going to be there. And so what are we seeing as well? Like we don't do a lot of structured credit, but we know a lot of players in the market there. That market is really frozen. I mean, there are opportunistic debt guys that are moving in and sort of picking up stuff. But that sort of flows through. So if you can buy, triple B CLO tranches at 60 cents on the dollar, like why would you buy bonds at, that much more? So the ratings sort of, you have to have some, there's there's some price efficiency, or money sloshes around to the highest return. So you see that. And the problem even for us underwriting things is like, asset values and collateral values, of course, are tied to revenue streams, right? Why is a piece of real estate worth $100 million or $50 million? Well, it's because the NOI is X. Okay, so if the NOI is potentially permanently impaired, and I definitely think that's an issue. And then you sort of think, yeah, it's tricky. And I would say, yeah, on a DCF basis, Keith, like you were saying, you think these are small blips, but I think when you're an equity investor that it's almost like a gambler's ruin problem. Like you have one position, like it might be great, but you might not be there to enjoy that greatness. So like a company that has the lowest cost producer of, I don't know, something, phosphate, and yet if you can get taken out if you're not careful. So this is a tough time in the equity market. But again, the volatility, I assume, is, well, volatility is your friend in the sense that it's required to make excess returns. So
Yeah.
I mean, I think one thing that's interesting, I think that we've seen, I know Demoteran's done this analysis. There's a huge difference in performance of companies that are levered and the amount of leverage they have in their equity performance. It's gigantic. So the guys that are the least levered probably are down about 15%. The guys that are most levered are down by 70%. So it's almost monotonically increasing the amount of how equity's gone down depending upon the amount of debt you've got. It's a very interesting sort of analysis.
I just love that you've worked in monotonically into this podcast.
Well, you brought up phosphate. Out of all things to choose in terms of a good, you choose phosphate. So we've got a nice.
There you go.
This is the way we think. Yeah, over to Jeremy. You had a recent communication, I know, with your investors, reiterating the approach of thinking like a business owner. Not a trader, forget about the financial side, or forget about the stock price or that type of thing. First, you have to analyze the company itself and look at what models you think can survive and thrive in difficult environments like this. It'd be interesting to kind of hear you elaborate on that comment of thinking like a business owner, taking that approach, which might be I think how most of us think, but is not necessarily the common view, amongst maybe the industry we're in.
Yeah, and let me know just make a signal if the audio gets bad. I'll talk in short spurts here. I think what I meant by that was
we cut out a little bit, but let's try it again.
Yeah.
I'll say it for Jeremy.
Read his lips.
People are watching Netflix in Europe right now, so we'll move on and we'll see if he comes back here. It says okay. I had a question, kind of more for the equity guys, and not as much for Thomas, unless you have a view on a couple equity positions that I know you do follow. But kind of kick it over to Dave. Is there a specific company, sector, investment right now at this price that's been affected that you're excited about, something from the watch list or something you might already own that you'd be interested in sharing?
Sure, and I'm a little bit of a broken record on this point, but a couple of my largest positions are rural telecoms, which is an industry I've followed for years and have been fortunate enough to do well in and feel like I understand very, very well. I have to say, in this current environment, I can hardly think of an industry that is less affected and maybe even slightly benefited by people having to stay indoors and conduct all of their, or nearly all of their entertainment, their work, their education via telecom services, whether it's, well, what have you, whether you're watching Netflix or you're in Zoom meetings all day or what happens, you have to have broadband. And so I kind of think in the terms of the hierarchy of household bills, maybe you have your mortgage and your health insurance and maybe your auto payments and your groceries, and then your telephone or cable bill is pretty high up there right now. Not a lot of cord cutting going on right now, I don't think. And so I think if you're a telecom and when you have a decent balance sheet and you are, especially if you're an incumbent in an area, you're doing okay. Yes, I mean, at the margin, your revenue might be crimped a little bit. You're not doing many new installations right now, but on the other hand, your churn is down because, like I said, who's canceling? And you're probably not sending a lot of field technicians right now, so your labor is down a little bit. So really, you're doing okay. I think on net, you're probably doing about the same as you were before. And yet, if you look at the share prices, especially of a couple positions that I have, Nuvera Telecommunications, Nuvera Communications, which is a Minnesota-based telco, and LICT, which is more national, has operations here and there. LICT went from 19,000 and change on the share price down to 12,000 at one point, and Nuvera went from around in the mid 18s down to the mid 14s for no real reason other than the stocks are not terribly liquid, and when somebody needed to get out, there were just not a whole lot of bids near the current share price, and so there was pressure there. But if you look at the underlying economics, they're not impaired, and they continue to be heavily backstopped by not only by their existing customers, but by the federal government, who in a rare area of bipartisan agreement can recognize the value of extending broadband access to rural Americans who will risk being left behind if they don't have access to those services. And so LICT is majority controlled by Mario Gabelli. He's a fantastic investor, and they have net cash on the balance sheet, quite a lot of it actually. They just happen to have sold one of their wireless partnerships in Northern California in January and pocketed around 20 million from that. So they're in a great position. I think they could easily either continue to buy back shares, which they do very aggressively, or they could do an opportunistic acquisition from a telco that maybe was over leveraged or just otherwise is being more disrupted than most right now. Nuvera is the very same thing. They have a strong balance sheet, low debt, good service area. I mean, there's those staid, strong Midwestern, stiff upper lip kind of people who are going to get through this just fine, and the share price will bounce back. I mean, Nuvera is doing well over $2 a share in free cash flow, and will be for this foreseeable future. And on a share price of 15, that's very attractive to me. And likewise, LICT doesn't have quite the same level of free cash flow, but given that they have a tremendous net cash position, they have that incredible optionality. And so I continue to hold these positions stubbornly, even as the market disagrees with me in the short term. But I see the value creation happening every quarter, and I don't think that'll change.
Interesting, especially when opportunistic buybacks, when you have a big capital allocator at the helm. A situation like this actually puts the company ahead, or allows you to increase your ownership interest by just continuing to hold on. It looks like we have Jeremy back. Jeremy, can you hear us? I spoke too soon.
I was too.
I can follow up to Dave's thing. I agree with him on the telcos. We own two international telcos where I think what's happening is their positions are becoming stronger. So the two ones we own are Italian Telecom and Korea Telecom. These companies are selling, Telecom Italia is selling for like 4 times free cash flow, 4.5 times free cash flow. And you have the same thing roughly around 5 times earnings or free cash flow for Korea Telecom. These are core businesses that throughout this, people will continue to use and utilize, and they're actually becoming stronger in these markets. And as a matter of fact, companies, both of them actually are moving towards more of a triple play or quad play type of situation in different ways. And so you get companies that right now are trading at these kind of multiples. And even today with the stuff that down as it is, the quad plays or the triple plays in the US are still trading at, probably multiples of, 3 to 4 times what these companies are trading for in like Korea and in Italy. So, I mean, I think that the telecoms is definitely a beneficiary of this. Another interesting area that I think is that people may not be on people's radar are car dealerships. And one thing that they've said in Wuhan is that after they've opened up, they've had a huge increase in car sales. And the reason being is people are very reluctant to do mass transit with a lot of people around. And so car sales is actually what's happened. And a lot of the car retailers have gotten, or dealers have really gotten hit pretty hard with this. And there's some really interesting names in the US, and we own one in the UK and one in South Africa that basically, these businesses I think will continue to do well given the fact that,
yeah, what does the balance sheet look like?
What's that?
What does the balance sheet look like for these? Do they carry a significant amount of debt or no?
Some do, it depends. I mean, some of them do carry debt, but they're not capital intensive. I mean, that in my mind is the key difference. I mean, companies that are not capital intensive, that carry a lot of debt, or carry some debt, let's say, but it's manageable. I don't have as much of an issue of companies that are capital intensive that have a lot of debt. Those are, I think, the latter ones, I think, are the ones that are going to be the bigger issue because they have to continue to invest and get. But the car dealerships are typically non-capital intensive businesses. And one thing we look at for those businesses are what's the inventory turns? How fast can they turn? And the ones that we like are the ones that have the highest inventory turns. So they're at a competitive advantage to other car dealers in the fact that they can turn their inventory, like Costco or any other retailer, they can turn their inventory faster, sell for the same or lower price, and make a higher ROE than their competitors.
Sure. It looks like, Jeremy, we might have you back here again. The question is kind of an extension of the question that I had originally asked you about, looking at it from a business perspective as opposed to kind of the trader perspective. Is there a specific company or sector or anything that you're interested in or something on the watch list?
Yeah, sorry about that. The internet connection's terrible here, and there's nothing we can do about it. It's overburdened. But I think my only point was that during when markets start going crazy, it's really important to think about what businesses are going to do well, what businesses are best positioned to survive and thrive, and flock to those businesses versus flock to value, not to price. So I think my message to investors was, don't be distracted by things that are down 90% or 95% with this dream of it's going to mean revert in the next month or 2 or 3. I mean, it's probably permanently impaired. Maybe it goes back up, maybe it doesn't. But instead of getting excited about those companies, try to think in terms of what would you buy if you were buying an entire business. And it wouldn't be trying to gamble that something goes from down 95 to down 60. But even if you had to pay a full price for a business that's going to survive and thrive at the expense of much lower quality competitors because a trend is being rapidly accelerated as a result of a recession, you want to own those companies and think 2, 3, 4 years out, not try to bottom fish and dumpster dive and trade on things just because they're down a lot. So that was kind of my point, was buyer beware.
Yeah, interesting. And I mean, I think from my view is I'm still fairly cautious, especially about some of those predictions or suggestions when you look at, think of the airlines or the cruise industry or these types of companies that look. I mean, if you say what's going to happen with that, you're lying or you're ignorant of yourself. We don't know what's going to happen, okay? And it pays to be cautious. There's a reason why they've been down so much. There's not only the demand destruction and uncertainty of how people will be coming out of this and utilizing those services, but then there's also all of the balance sheet items associated with it as well. What is the government going to do about the airline industry? There are certain airlines I just saw recently are selling, they're attempting to sell some of their points to the banks at significant discounts. That's going to have a long-term effect. There is impairment. There is long-term and permanent impairment in many of these businesses, and it's very difficult to ballpark if you're trying to arbitrage how much the stock price has gone down relative to what that permanent impairment is. That's a really risky, difficult thing, and if you have certainty associated with it, you're fooling yourself. So I'm taking a cautious approach on that. In my view, the things that I'm looking at right now are companies like Dave mentioned, where there's good capital allocation, where there may not be this permanent impairment, that demand is still there. There are areas that have even possibly been have positive ramifications in this environment. And I'm looking at share buybacks. I'm looking at insider buying. When you look at what some of the senior executives, and I particularly like to look at the CFO insider buying as opposed to the CEO. Sometimes that can be a little bit superficial when you're looking at CEO or board members, but the CFO knows the financial condition of the company. They're typically not aggressive people. They don't do these things for superficial reasons. And when you see insider buying at a stock price that might have dropped significantly in the industry or company that is making efficient and effective decisions on capital allocation, that's caught my eye. Liberty Global, or not Liberty Global, but Liberty Latin America, a couple of weeks ago announced a $100 million buyback on, I think at the time it was a $1.2 billion business. Obviously, we have strong leadership there and the shareholders associated with it, like Malone and others. And so a company like that is what I've been looking at, where they actually will come out ahead in the long term because of having a cash position and making effective capital allocation decisions, either to buy back shares, to take market share from competitors, to go on the offensive during this time period because they had strong enough balance sheets to do that. And it'll be interesting to see if value comes back, as opposed to growth. It seems like it should, but when we have the Fed and the low interest rates and different forbearance and things like that on the debt side, you'd like to think value would come back, because a lot of us, initially in terms of our analysis, our fundamental analysis, we take a value perspective and approach. But I think there's uncertainty there as well. I think if you go back in 08, there were companies, or sorry, funds, investors that would kind of get a basket of nets and go from there. I'm not sure if that's the way to do it today or not. It could be, it might be, but on the other hand, the demand destruction there that might be permanent. It's just a very difficult environment, and I think it pays to be cautious.
Yeah. And I published a piece that's on our website called it's on the survivors and thrivers based on different major market cycles, and the most dramatic was kind of the 2008 October 7th October 7th 2008 was, or 7, I'm sorry, was the top of the peak of the crisis, the pre-recession crisis. And if you follow the returns of the top companies, the companies that outperformed the absolute most, if you bought at the absolute peak and held to the next peak, they were never companies that were trading cheap. And the bottom performers were very low quality companies that were cheap then, and they ended up cheap in the end. And they not only did they not outperform, but they underperformed by dramatic amounts. So I think just using some of these old ways of looking at companies is a value trap. And think about it from this perspective. I mean, I was thinking about Hilton the other day. We don't own Hilton, but it's one of the ways I try to look at earnings calls of these big global companies to get a sense of what's happening in the world. And if you're Hilton and what's happened to your business, and your marketing budget has been crushed, and you maybe have 10 or 15 or 20% of the original marketing budget that you had a year ago. And so how are you going to spend? So you're probably going to sit around with the staff that's remaining in marketing and say, okay, look, we've got 20% of the money to basically reboot this business. Where are we going to spend that money? Are we going to go to radio? Are we going to, of course, they probably weren't at radio, because maybe smaller companies were. Are you going to go to, I mean, how is that ad spend going to happen? And I think you can think about, it's going to probably go to the highest quality companies and opportunities that, to maximize the return on the smaller amount of capital that they're spending. And I think that's true with all companies across all ways that capital is being spent. And so there's going to be a flight to quality within sectors. Now, that doesn't mean you have to own the largest companies in the S&P, but when you think about what businesses are going to perform the best, when we look back on this, we look back at, God, what should we have owned if we had to buy at the peak of 2020? It's not going to be companies that were trading the cheapest. It's going to be companies that were the first picked because they were the number one or the number two in their niche, and they were able to grow at the expense of competition. Even though the economy was shrinking, they were able to grow. And that's where the biggest returns are created. So it's about putting value first and price second.
Yeah.
And that's kind of proven out looking at all the past peak to peak cycles, even in the 2000, to 2007 peak to peak. The companies that really outperformed after the dot-com bubble, even if you bought the last day of the peak before the dot-com bubble, were never necessarily trading for the absolute bottom. They were never the bottom barrel companies. They were companies that were able to survive and thrive. So people say survive and thrive very loosely, but they typically have the survival bias, because surviving is not enough. Most companies will survive as long as they don't go out of business because of bankruptcy, but the ability to thrive is left for only the top few. So the top 10% of companies can actually thrive. So if you think about it in those terms, looking at businesses over like a 10-year, 5-year period, you would probably think, well, that's my original point, was that thinking about investing, thinking about stocks like a business owner, I think that would be the approach of the business owner versus a trader who would be maybe looking for just a quick bounce in a stock price because it's screened cheap.
Much more qualitative approach, which I think, we're all looking at that as well. And then how do you carry that out? Exactly like you said, I think the Hilton example is excellent because you have, in terms of advertising today, you have such a wide range of options that did not exist previously. And, certainly there are some traditional forms of advertising that will likely be diminished because it's not measurable in many ways too. And it'll be interesting to see how that how that all shakes out. And you can extend that analogy in a lot of different areas and industries, that there will be changes, and we'll see what those changes are. But ultimately, the top performers, that from a operational perspective, will have that significant advantage. Nicely for us too, if you're not a trader, that allows you to kind of own those companies over extended time periods and benefit from their internal allocation. And not have to kind of jump around from stock to stock, deal with the tax consequences from that. Ideally, you want to find a company that has significant high recurring returns on invested capital. Last question for the entire group. Most of us, I think, I'm not sure if you write a quarterly letter or not, Thomas, but at least some communications with your investors. But talking about the quarterly letters, we're at the point where I think most of us are preparing those letters. And if for any viewer here or listener, if you are a qualified investor and you're not on our mailing list, you can send a note over to Jessica Greer. Find your email address on the Willow Oak website, and she can qualify you and put you on the mailing list if you'd like to for any of these communications. But at the time here, we're a couple weeks in. It's mid-April. We're preparing our kind of more formal thoughts with investors. Would each of you be willing to give a little bit of a preview, of what you're thinking about putting in that letter, something that might be in the draft already? Or Thomas, if you don't write a letter, is there any kind of a brief overview that you are discussing with some of your investors right now that you'd be willing to share?
Yeah, sure. So, I mean, we basically work for family offices, and one in particular is our sort of sizable client. So we talk more than every quarter, and we're sort of talking to them constantly. And I'm sure you guys as well. They're talking to your LPs from time to time. But I would say interesting. It kind of leads on to what you were talking about just before, where you guys were talking about quality. Everybody in distress tries to do the same thing, that almost like, in the stock market, everyone wants to find the fallen angel that's going to go up 10 times off of a bounce, and they're going to be right, and they called it. The funny thing about distress is you really don't make very good money by buying junk. You can do things where you sort of, just like net, you sort of flip things, or make a quick double because the comp is here and you bought it here, and it's all milting, but you got the milt just right. If I were to write a quarterly letter, it would be around this idea that it's now the time to be even more aggressive on quality, because you have that opportunity to potentially get these things at better valuations. It's probably the real true distilled secret of intelligent investing is good valuation. So So now's the time. So yeah, so but I'm interested to see what other people are saying.
Right. Yeah, over to Dave. Dave, what are you looking at here's some of your thoughts for the quarterly letter?
Oh, apologize. Didn't hear you. Yeah, I've never been the biggest investment philosophizer, so I tend to leave that to other people. But I do have some thoughts about just about stability and about balance sheets and about managing those through the full cycle and about being so I guess contracyclical in terms of balance sheet management and in terms of capital allocation and how to identify firms that do that well and how to identify ones that honestly just go full out at all times and end up getting really, really hurt when something like this happens. But more so, I'll talk about a couple new ideas we have, some things I was able to add to opportunistically over the last quarter and how excited I am about those. And mostly what I really, really love is profiling little situations. And I think my excitement comes through sometimes in the letters as I hope it does. So yeah, a couple new names to talk about, some developments and old names, and just always look forward to getting my thoughts out there. And I get a ton of great feedback from readers, and I always look forward to that as well.
Right. And Jeremy, anything to elaborate on what you previously said? Any additional thoughts here on as you draft your letter?
Yeah, just I think I'm going to focus on maybe the business case. I think now it's the time not only just to look at quality, but to think about a business in terms of the real business case for owning it, and not just the financial reason to own it. And it's a really exciting time because, as I was saying earlier, as a lot of things are being sped up, the way we do things, the recession will have a way of speeding up things that were kind of slow or lingering before. So it's a really, really exciting time to own certain companies that will benefit from that at everybody else's expense. And hasn't been a ton of changes to the portfolio. We've added two kind of positions, and they're funny enough in advertising, which is kind of why I mentioned it's a little bit on my mind. But I'll be talking about one of those companies and what a kind of an exciting time it is, not just because things have gone down, but yes, things have gone down, and that is one step of the opportunity. But the real long-term opportunity is the long-term growth of companies that are on the right side of the tracks, so to speak.
Great. And Keith, what are your thoughts?
Well, I mean, I think there's two themes I'm going to talk about. We've talked pretty much about it here. It's just the bifurcation between the quality and the non-quality businesses. And I think the market's sort of done a pretty good job of at least in the short term being able to separate the two. And this even extends beyond just companies. It extends to countries. I mean, I'm surprised at how well, for example, the Philippines currency and Korea and Hong Kong has done on a relative basis given versus other countries. So you have a sorting on a number of different levels, on a country level, on a company level, and then also within industries. So in essence, I think it's a very interesting sort of time from that perspective. The other thing that I'm probably also going to describe, which I've described in the past, is the amount of additional return that equity investors get versus bond investors. I mean, this thing has really created a very interesting situation where the bonds continue to go down. And you take a look at past studies about pandemics versus wars. Pandemics actually reduces the cost of capital. Take a look at the past interest rates have gone down considerably more. And part of the reason is in pandemics, you're not destroying capital. You're destroying, some people die, which I guess is some human capital. But the key thing is that in pandemics, it's not like a war. In a war, you're destroying capital. And any new capital that comes into a capitalistic system gets very high returns when the country's rebuilt. But a pandemic doesn't necessarily destroy anything from a physical capital and from that perspective. So, and just talking about that difference between right now, the spreads are relatively high in terms of between equity returns and bond returns, even with the slight decline, with the decline we've had in the market. And the question is, what's going on with long-term interest rates? And given, through this whole thing, capital hasn't been destroyed. Capital's still there. It just changes hands. In a bankruptcy, capital doesn't get destroyed. It just goes from the equity holders to the debt holders. So the capital's still there. And it's going to be interesting. I think just another interesting trend of, coming out of this, we're going to still have, if we still have relatively low interest rates, the spreads are still going to be very, very good for a number. The one interesting thing that's happened in this past month is a lot of the high yield spreads have blown out. I mean, they were like 3-4% before this, and now they're up around 9-10%. So that's another interesting sort of potential area to invest in if you find good managers that can do that. Is that right now you're starting off at a very good point from expected return perspective, and a lot of high yield / distressed, maybe not even distressed, but just generally high yield type of bond.
Well, great. Thank you each of you for participating today. Thank you to the viewers and listeners for joining us for Willow Oak's Value Hour. I encourage you to follow Willow Oak's YouTube channel, subscribe to it if you can. You'll be notified as new content is put up. We're planning here at Willow Oak to add additional content to be more active with some of these videos and audio things like that as well. Our next session actually will be with Jessica Greer at Willow Oak Asset Management as she discusses operational matters with one of our service providers at Whitfleet, who is an auditor for several of the funds. It should be an interesting session for private funds as well as investors who are interested in learning more about infrastructure and operational due diligence. So thank you again to everyone for joining us. Please stay safe during these extraordinary times. We look forward to seeing you again soon.